Something that I think is becoming pretty clear is we're set up to repeat something we saw in the 80s, where kind of the small and medium-sized banks really had a great consolidation. There was a lending kind of asset-backed environment that went down, was very much real estate oriented, obviously. And I think we're kind of repeating that cycle. This is not the global financial crisis. I think there was an open debate about that a year ago. I think at this point it is pretty clear it's not GFC, but it could be savings alone. And savings alone was pretty bad. And most importantly, what people don't get is it was long. It was a decade. It
Yes.
wasn't an
Yes.
event. What do you think, Anna?
Yes, absolutely. And we talked a little bit about this, before, but things are just continuing to unfold. And it's interesting how different news sources use different data that shows different percentages. But in the ones that I'm seeing that are the most reputable that went back and looked, about 63 to 67% of commercial real estate loans, including loans that are done through their investment department. So most banks have a residential side
Mhm.
and a commercial side. And even if you're buying a single or a duplex or a quad, most banks put you in the commercial loan side of their house because it's not your primary residence. And so when you include all the loans made to investors in real estate, from any size property, it's over 60% of them are done by local and regional banks, meaning these small banks that are lending to real estate investors and to small businesses. So that's the number of small business loans and commercial real estate loans, investment loans together. It's a very large percentage that goes to those small and
Mhm.
regional banks. And so where is the pain today in this financial crisis? We talked about in video number one, many banks who are holding bonds in their hold to maturity portfolio, but also the pain is in commercial real estate and in small businesses that are very debt dependent, who have depended on those very low interest rates we've had for most of the last 15 years with some blips in between. But when you have almost free money on an
Mhm.
inflation adjusted basis, it was free money for some time, it pushes up asset values. And so when interest rates start to rise really drastically, not only do asset values come down, and our debt is the bank's collateral, it's their asset. When they give us a loan, it's their asset. So if our collateral values are going down, the value of a business, because their earnings are coming down, or the value of real estate, because that cap rate or that interest rate that impacts values is rising, brings values down, all of a sudden these banks say, wait a second, our balance sheet is really skewed. Their assets are coming down. Their liabilities in some cases are going up as well, and their depositors are leaving. And so these small and local and regional banks have a lot more pain as a percentage of their balance sheet than these big banks like Bank of America. So as interest rates stay higher for longer, more and more investors and businesses, number one, the value of their asset may be less than their loan. So they may hand back the keys if they have a property, or they may say, I'm defaulting on my loan if they have a business. But the other thing is, even if they can hold that asset for a long time, their debt service payments in some cases have tripled and quadrupled now.
Mm.
That's how bad things are, Michael. So if a company, says, I'm making a payment to my bank, and my payment's $6,000 a month, and then that term of that fixed rate expires, like they all do in
Mhm.
the commercial lending world, whether it's real estate or not, then all of a sudden your mortgage payment can double or triple. And if they can't service that debt with their income, the bank may have to foreclose on the loan, even if they're making their payment. So
Yeah.
that's what's causing all this pain. And it's not, like you said, a suddenly. It's not like, things are okay and then all these banks fail. Because these loans have varying terms of maturity over time, we're just seeing the very beginning of these loans that were made a few years ago that are maturing this year. But we've also got a lot of loans that were done at 3 to 4% range throughout real estate and commercial loans in 2022 that won't mature until 2027. So I think that this is a multi-year event that
Yeah.
we start seeing these defaults that start impacting these banks that will then start going under. And until then, I think it's going to take equally as long. They're going to stop lending because they simply cannot continue to lend while they're
Yes.
dealing with other loans. And that is really where it's going to create significant pain for the economy that has not yet unfolded.
Yeah, when I think of the small and regional banks, I kind of see it as a three-legged stool. And unfortunately, each leg is full of termites, right? We can start with deposits, right? Depositors, now just this happened in the S&L crisis. They had better options.
Yes,
Banks were paying, 1% or less a year ago. The big banks still are, but the little banks are now paying 3, 4%, whatever. Just like the S&L crisis. Folks, you don't know this, but in the S&L crisis, banks, or at least savings and loans, were capped at the interest they could pay. And when you had Paul Volcker ripping rates to, 18% or whatever it was, guess what? Deposits fled.
I
What has
didn't
happened?
realize that they were capped. That's a
They were
new piece
capped.
of information to me.
Yeah, they were capped.
Makes
I think they
sense.
were capped at 8%. It might have been 6, but there was a regular, and it may have only been savings and loans because they were
Mhm.
insured differently, but regardless, they were capped, money left, other options, right?
Yes,
Happening today. So not, that leg is very weak. Then you
yes,
have their existing balance sheet, right? They can't undo these loans. They're there, right? They got the bonds, and those are full of termites and getting worse seemingly by the day. And then
absolutely.
then there's the hope, the income side of the statement. And that is basically net new loans. So how can we kind of work our way out of this or grow our way out of this? It's with new business. And that's not working. So and then finally, it's going to be minimum 4 years and probably 8 years of just pain. And it's not going to be a rip the band-aid off. It's going to be death by 1,000 paper cuts or something. It's going to be painful.
Yeah, I think so. And when you talk about the amount of credit that dries up, investors like us and companies, they're used to going to these small local banks where they have a relationship. And so that relationship is the key to keeping the bank open because they need to be able to, they make more money lending usually than they do on deposits. And so they need to lend, but yet they can't lend. And a lot of them are pulling back. And so their profit margins are going to be squeezed for a long time while they're dealing with, trying to figure out how to keep their balance sheet healthy with loans that may default. And they really can't afford just to extend your loan at a low interest rate because a lot of people don't realize that when they're giving loans, they're also, buying securities on the other side that basically give them a better return. And so, there's risk management that's done with banks where, every loan that they do, every asset that they hold, they hedge kind of on the other side. And so they're very interest rate sensitive. If we get a 30-year mortgage, on a single family home or, a vacation rental or whatnot through Fannie Mae, they're buying a 30-year treasury essentially to, offset that mortgage. And so, you're looking at banks who can't just extend and pretend the way some agencies might be able to try to do. They'll try for a while, but I just read an article that came out, and it was specifically talking to some regional bank presidents about the commercial real estate crisis and the fact that they're trying to work with buyers to some extent, but they're really limited on what they can do because of how high interest rates are today. And it may cause them, even more losses monthly to, let people make smaller payments or whatever they need to do to extend than just doing a once and done write down and trying to sell the asset and moving on. So, I think these regional banks are hurting. And like you said, it was a good analogy. There's like termites on all three legs. You're gonna start seeing them fall and being absorbed by bigger banks. And so I think
Yeah.
at the end of this, over the next several years, you're going to have far fewer banks than you do today, which is not good news for those that want credit, because I don't know how many of you try to get loans from, Bank of America and Chase and Wells Fargo for your real estate investing, but I have
Painful,
not had good
painful.
experiences with them. And most of them are using Fannie Mae type of loans anyway that are sold as MBS. So
Mhm.
it's going to hurt investors. And again, why I say it's important to have multiple bank relationships.
Yeah, and the biggest thing that I don't think people are talking about is, you know, deposit flight predictable, a balance sheet that has some bad assets on it now because you were lending at zero, understandable. But I don't think enough people understand the impact on net new business. The fact that the regional banks are going to pull back, I don't know, 40, 50%. It means less companies are going to start, less new stuff's going to get done, less building. I talked with Lance Lambert, who was a editor at Fortune, now running his own thing, Resi Club,
Yeah,
and I told him, I said, I think there's going to be a lot less builders doing projects, and we're already seeing it. I mean, if you saw the home building stats this morning, they're finishing what they've done, but they're not starting new ones. And
absolutely.
that's going to be a problem in 6 months when, if rates come down, there's no inventory. I mean, it's all predictable. And once the dominoes fall in housing, it takes months and quarters to kind of get back going. It's just
Absolutely. And I'm
painful.
seeing that in the real world because we're in the middle of developing some projects where we've already had the land and we had lenders, committed to the project that had to say, we love you, we love the project, but we simply can't
Yeah,
lend
it
this money
can't.
to you right now. It's
Can't.
too much. And a lot of people don't realize that when you go to a bank, they're not just sitting, we needed $100 million loan for a project. Okay. The bank doesn't have $100 million to give us, but they basically co-broker it. So
Mhm.
they reach out to other banks and say, we have a great project. We want you to help, lend on this. We'll be the bank sponsor that looks like we're lending the money, but you're each going to take a piece of that to lend to this project. Well, as we have deposit flight, and as they have to market some of these securities, these banks have to raise their reserve requirements. And because they have to now hold more reserves when there's less deposits, they simply can't lend out as much money. And I know that there's some that will argue with that, but I've seen it in real time. I'm dealing with it in real time. And this is what the banks are telling us. Like, we have to hold on to liquidity at
Yeah.
this point. And they believe that real estate, especially development right now, is risky because you
Yeah.
you have a pro forma that says it should cost me this much to build it. My income should be this much in rents. My expenses should be this much in taxes and insurance and everything else, which are going up. And my value should be XYZ on exit based on a certain cap rate. Well, when you're in a volatile economic situation where we don't know where rates are going, and where even though the Fed is saying we might be done and we're going to hold, they're seeing the volatility of the bond market and supply of treasuries that aren't being absorbed and rates going up there. And they're going, you can't really predict your exit cap. You can't really predict what's going to happen with taxes and insurance, which have gone up substantially, and there's no end in sight. And so all of the numbers are fairly unpredictable. And so, development is risky. When we do a development deal, we tell our investors, this is risky. You could lose all your money. We do a lot of things to mitigate that risk before we will do a deal. And we're on hold on a few of our deals because the external factors are more than what we can necessarily mitigate in certain projects. And banks know this. And so they're
Mhm.
saying, I've already got risky debt we've got to deal with. I can't lend on anything that doesn't have a proven track record of performance, like a value add stabilized deal. A new development deal, whether it's a single family house, whether it's a build to rent community, whether in its apartment complex, simply has many more unknowns as to what is the ultimate net income and value going to be on those properties. And so banks are just on hold. And to your point, that's going to create in areas where there's a lack of supply already, it's really going to constrain supply for several more years. And that creates even more affordability issues for us that have properties in those areas that have a lack of supply. It's good news for us. We stay highly occupied, high rents. We're still pushing rents in our area because there's a lack of supply. But
Mm.
I think you are going to see trickle in, Michael, some more federal programs and maybe state level programs that try to incentivize builders to keep building by giving you, tax abatement and grants and tax credits for, building affordable housing. So there's opportunity there for sure. But there is a lot of pain if you're already one who has been in that business, home builders, apartment builders, et cetera.
Yeah, one of the really odd things that I see, again, kind of playing these dominoes out like I try to do, is at these high rates, builders are pulling back, projects are mothballed or put on hold. That impacts, stuff in 4 to 6 to 8 months. And what are we trying to fight? We're trying to fight inflation. What is one way to beat inflation is to get freaking shelter costs down. If we don't
You
have the
need more
product coming to
supply.
market, ah,
Right. It is almost like a doom loop, right? And you and I are always trying to find the silver
yeah,
lining and find opportunities in the pockets of pain. But the reality is we have pockets of pain. And
yep,
again, this article that I just read, I think it was on Globevest or something like that, that was interviewing a regional bank that does a lot of commercial lending. They said, we're probably not going to be lending on commercial real estate for 3 to 4 years at this
oh,
point, 3 to 4
wow.
years, because of this exact situation. And so, that's just real estate. But think about all the small businesses also, Michael, that are impacted by the same
Exactly.
thing. You want to start a new business, but you're starting it in a time that you can't really say, well, my income's going to be this. This is what the demand's going to be, especially if it's something that's, not a necessity, but it's
Right.
basically, consumer expendable stuff on things that you want but you don't need.
Yeah,
If your
discretionary.
business is completely discretionary, thank you, I'm still in my second cup of coffee. If it's completely discretionary, the banks are going to say, how do we know that people will keep spending money on what you want to sell, your goods or services? What are your expenses going to be? How much is your building, rent going to cost? And what kind of multiple can you get on your business if you want to sell it in the future? And those are all unknown. So the same way that credit is tightening for real estate, it's also tightening for small businesses. And so
Exactly.
unfortunately, I think you're going to see a lot of small businesses start to fail. You're already seeing some big name bankruptcies in, CVS and Rite Aid and Walmart and Bed Bath and Beyond, not Walmart, Walgreens, um,
Walgreens. Yeah,
and
yeah.
some of these other.
Yellow trucking.
Yeah,
Yeah.
yeah, lots. There's a huge uptick in
Hmm.
in big company corporate bankruptcies, but these small companies that rely on these small local and regional lenders, they're going to be hurting for a while too. So it's not good news for the economy for several years. And a reason, again, I don't think that this recession, whether we're in it or not now, it very much feels recessionary. I don't think it's going to be like a quick blip. I think it's more like a rolling recession where we're going to see the fallout over multiple years, and there's going to be different pockets of pain. You see trucking. Trucking is in the worst recession right now in a really long time. And so you've had this manufacturing blip, you've had a trucking blip, you're seeing the banking and real estate, consumer expendable discretionary pharmacies, things like that. So I think that you're going to have several years of this,
Yeah.
painful economy where it's hitting small businesses and investors. And again, you got to say, while there's pain, how can I not sit here and, cry, a tear in my root beer or whatever, but how can I take advantage of some of this pain and find the banks that I can work
Yep.
with, find private money who still has money to lend, and still find ways that I can purchase, properties, maybe purchase some small businesses if you have the fortitude and the experience in order to be able to do so. There's still opportunity, but credit is just starting to tighten. And historically, credit tightens for at least 6 months pretty bad, and then for another 2 to 3 years in recovery. This could take even longer. So the decade of free money, Michael, absolutely, no doubt, is over.
Yes.
Unless we have something really bad break and the Fed has to drop rates back to the zero bound for a temporary period. If they do, I'm going to go refinance everything for 10
Mhm.
years, as long as I can. We need to just expect that rates are going to be higher, credit's going to be higher to get, and we have to get really creative as investors. And relationships are really, really important for us to be
Yeah.
able to do that.
Yeah, the next 5 years are going to be kind of this, especially in the small and regional bank. It's going to be the termites. It's just going to be bad. But it's going to be about the good operators. You know, good operators
Yes,
were crushing it in the 80s, and they were buying assets and they were negotiating deals that they look like geniuses a decade later and looked really good. I mean, Sam Zell became a billionaire because of the S&L crisis, and many others did as well. So I look forward to what is
absolutely.
coming. In video number 3, folks, we're going to catch up with Anna Kelly and her VA assumption. We'll just tease that. Anna, where can they find you?
Great. You can find me here every week on your show and on my playlist on your channel. You can find me on social media, Anna Kelly, REI Mom, and my new website for coaching and consulting for your finances and real estate needs at AnnaKellyInvesting.com.
Awesome. Thank you so much.